So how should you balance risk and reward in Forex trading? Very simply, you need to earn more than you lose on average. And the experts out there tell you to go for 1-to-1. So very simply what this means is if you put your stops 40 pips below your entry on a long, then your average profit needs to exceed 40 pips. If you can get 80 pips, great. But that ratio needs to be 1-to-1 or higher in general. And that does depend on your percent win rate. So that's kind of the basic math out there. How we balance risk and reward in manual trading is a bit different. And as I mentioned, we're moving from a manual trading strategy to an automated trading strategy. So we are cognizant of that, and I want to explain both ways of managing risk and reward. General George Patton here said, take calculated risks. That's quite different from being rash. And all of this is investing and not gambling. So you very much need that strategic plan for how you're going to take risk, what size bets you want to use, how you're going to manage that, how much you're going to put at stake at each point in time. Pearls don't lie on the seashore. If you want one, you must dive for it. And this Chinese proverb explains that scary part of the trader's gut where you've placed the trade, everything looked great, and the trade is now moving away from you. Well, most of our good trades do move away from us before they come back in our favor. But we're medium-term traders, so we're not going to jump out and second-guess ourselves. We have a very carefully controlled plan, and we put that into motion. So once we have set that trade in motion, unless it hits specific points, we're not going to take other actions. We're not going to double. We're not going to doubt ourselves. So let me just go over some real key principles here. First, know yourself and your risk tolerances over the long term. Can't say that enough. Knowing yourself and your risk tolerances. How do you know that? Well, that really gets down into the third bullet. It's what allows you to sleep at night. What allows you to talk to someone that would hold you accountable and be comfortable with that. You need to understand, if you have customers, you need to know what they're comfortable with. Inform them in writing of your maximal drawdowns that you have planned. So we want to take that worst case in mind. And for some people that might be 2%. For other people it might be 5%. Others 20%. And we have wonderful traders out there that are comfortable going into 20% drawdowns. For me, it doesn't exceed 5 or 10%. So I want to take that number and divide that by the number of campaigns that I want to wage simultaneously. And so in realistic terms, that means I don't really want to go down more than 3 or 4% on a given campaign. So that means I have to structure my initial trade size, my secondary and tertiary additions to that trade size in order to never exceed that 3% on that pair. And this idea of having multiple campaigns is important too, because you never want to just stay stuck in a drawdown and not have something that you're trading to get you out of it while you're waiting on that to come back in your way, in your favor. Number 5, patience. Most of currency trading is range trading. And if you keep that medium-term perspective in mind, then you'll be healthier. We have one of our trading coaches actually says, doesn't matter which way you pick, you can make money on this pair, because very much in Forex trading you're going to have a movement through the cycles, and most Forex trading, something like 97% of it is range trading. So if you're patient and things don't get too far out of alignment, then you'll be fine. If things do get too far out of alignment and you have a hard trending move, then yeah, you need to take the loss if it's not in your direction. Number 6, high beta pairs like the Australian and the New Zealand. These guys move. They move 2 to 3 times as far as the pound will move on a given basis. And you can see it if you go back into your weekly and monthly time frames. You'll see the difference. They move further. They're called high beta pairs because they have, high beta, high risk. They move more. So you need to either reduce your trade size there or take a longer term perspective. I recommend trading them with about half the trade size you would use on the pound. Number 7, be prepared to take a loss at some point if need be. as I've said before. Number 8, self-discipline is really remembering what you want. So the rules are there because they're your rules. They're to help you remember what you want, how you want to trade, and how you want to allocate capital and be comfortable, how you want to sleep at night, knowing that you are in line and you're not going to lose your nest egg, you're not going to lose your company. You're going to commit to this plan in writing and find someone to hold you accountable. I highly recommend that. And lastly, a little quote of wisdom from Peter Drucker. What you have to do and the way you have to do it is incredibly simple. Whether you're willing to do it is indeed another matter.